Great. Well, I'm excited today to have a little bit of Bond 101 discussion. I'm joined on the screen here by Don Annino, who is a director of portfolio specialists at Lord Abbett and has been at Lord Abbett since 2006. Don and I caught up briefly, and I asked a big favor, which he's granting, which is about a 10-minute call to just talk through what is happening in the bond market. And Don, thanks again for joining us. I'm excited to kind of take a few minutes and have you educate myself and clients and prospective clients of Ausperity Private Wealth. So thank you, Don.
Sure, you bet, Rory. Thanks for having me. Appreciate having a chance to speak with you and help hopefully provide some clarification on what's been going on in this pretty challenging market we've had so far this year.
Yeah, it certainly has been. So let's kick off right there. What is happening in the bond market, and why are bonds having such a tough year in 2022 here?
Yeah, it's a great question. I saw over the weekend actually a headline from Bank of America said this is actually the worst year for the 10-year Treasury since 1788. Now, I don't know who's been keeping records since 1788, but in my tenure, in my career, it's worse than the previous worst bond market of 1994. And the answer is interest rates, right? When rising interest rates are the enemy of bonds, because bonds have typically pay a coupon that's fixed. And when the market requires more and more income, the only way for that yield to go up is for the price of that bond to go down so that the market gets its required rate of return. And we have been through a very, very challenging change in interest rate environments. As your chart is showing.
Just to jump in briefly, so
please.
Can you, just to make sure my screen sharing is working here, I have a year-to-date 10-year Treasury, the yield's up 169%, and this is what we're talking about, the bond aggregate, which is essentially the S&P 500 for stocks. Well, the bond aggregate, or the U.S. Ag, is the appropriate index that we track for bond performance. So you got the bond market down 15.5% as of yesterday on a year-to-date basis. So just wanted to kind of jump in and provide a visual to back up what you're going through, Don.
Yeah, absolutely. I mean, and that chart tells the story, right? You had a 10-year Treasury coming into the year yielding about 1.5%, now yielding about 4%. Even more dramatically, you had a 2-year Treasury coming into the year yielding less than 0.5%, now yielding over 4.5%. That's why it's been nowhere to run, nowhere to hide. That rising rate environment puts a lot of pressure on bond prices. But remember, bonds always come back, right? So if a bond gets pushed down below par value, it's going to mature at par. And that's the environment that we see right now. That's why we're excited for investors to take a look at the bond market at these new prices, at these new yields, and consider the potential of allocating to take advantage of some of these attractive rates.
Okay, great. So I'd love to get into that more. Maybe let's back up. Let's go Bond 101. So how does a bond work? And maybe even if you can compare to stocks, take us back to school here. What is Bond Investing 101? How does that work?
Sure. So the easiest way to explain it is when we buy stock, we're basically buying a small piece of that company, right? We are a fractional owner of the company as indicated by the amount of shares that we hold. When we buy a bond, really essentially what we did is we lent that company, we'll use a corporate bond as an example, a specific amount of money for a specific amount of time with the expectations of getting a specific amount of interest. So we're going to get our interest payments for the period that we've decided on for the maturity of the bond. And at the end of that period, we're going to get our money back. So buying stock is owning, and buying a bond is actually lending. So what happens is you determine the maturity that you want to buy. Let's say for this purpose, it's a 10-year bond, and the bond may have a 3% coupon. That means you should expect to, if you paid par for the bond, 3% per year, and at the end of those 10 years, you get your money back. That's the basic plain vanilla explanation of, let's say, the life cycle of a bond. Now, of course,
fair to say, like bond could be $1,000 par, right? Purchase date, and then end date, or purchase date and end date is 1,000. But what I think investors struggle with is in the interim, the price of that bond can fluctuate. and there's a number of factors at play there. From what you opened with, interest rates is the number one at play currently, not defaults. We're not seeing bonds go bankrupt to a large degree. It's more an interest rate play, to where if interest rates are rising, current new issued bonds are just more attractive. Using your 10-year Treasury example, would you want to buy a 10-year Treasury paying 1.5% like in January, or buy a 10-year Treasury today at 4%? Well, the ones today are more attractive. So any of those bonds that were issued in January, what's happened to that price? The prices have dropped. And that's kind of the main catalyst for the loss there. So any other clarification or anything else to add in terms of why interest rates rising is really putting so much pressure and causing bond prices to drop? And then what do you do? If you wait, are you just going to get that? Is that going to be recouped, or is there potential permanent loss at play here?
Right. Well, that's the I think that's the operative question, Rory. If we're talking about high quality bonds with a very, very low probability of defaulting, then that bond will make its way to maturity, and that issuer will have the ability to pay you back, and you will accumulate all of your interest payments and get your principal back at the end. And those bonds, the higher quality, the more certain you are to get your principal back, the less risk there is, obviously, of a default. If we're talking about, let's say, a lower quality, let's say a high yield bond issuer who has a double B or single B rating, that throws in a different factor, because when you wake up as the holder of a U.S. Treasury in the morning, the only thing you're really concerned about is, could people coming into the market buy a Treasury similar to yours at a higher yield, right? Because the U.S. has the ability to produce dollars, to make their payments on their interest payments, and return your principal. When you own a low quality bond, a company that maybe is really early and it's not really been determined by the market if it's going to survive for the long haul, what you really are worried about is that that company can continue to execute and earn revenue and make the money to pay its payments. So that's why there's interest rate. All bonds have interest rate risk, but lower quality bonds have credit risk in addition to interest rate risk.
Got it. Okay, great. I'm going to pivot here and just go to kind of maybe take a deeper look. So what I have on my screen is just an ETF that tracks the U.S. Ag, and some things to point out, but I'm going to make my screen a little bit bigger so it's easier to see here. When we mention, $1,000, we'll call it here $100 par or price. What we're seeing today is, it looks like to me, the average price of a bond in the bond market or the Lehman Ag is at 87. And then we're looking at a yield to maturity of 4.6% on my screen, and then duration 6.4 years. Could you just talk us through educationally, what does that mean? The average price is 87, the yield to maturity is 4.68, and then the duration is 6.4. For those that might want to evaluate either the investments, the ETFs, the mutual funds that they're holding, those are pretty important numbers. Can you just speak to those briefly?
Sure. Let's take them. In order of I think significance. I think the most significant number that you quoted for the index, Rory, is the yield to maturity. So what that means is, that's the combination of all of your remaining coupon payments that you're going to get from this investment, combined with the time frame that will take for those bonds to reach maturity. So your 87 cents on the dollar that you mentioned as the average price will go back to a full dollar over the remaining time of the maturity of the portfolio. And then you'll also receive those, those coupon payments over that period. So it's somewhat imprecise, because things can come in and out of the portfolio and in and out of the index. But that's a way to compare this investment to something that might be of a similar sort of structure, and determine, is that yield to maturity attractive versus other choices. And then real quick, duration is just your sensitivity to interest rate changes from this day going forward. So it's an inverse relationship. If rates if the rates continue to go up, there could be a little more pressure on that 87 cents on the dollar price. However, if we get some rate relief and rates actually come down, that could put that 87 cents on a faster path toward par and a quicker path to recovery if we get a favorable shift in the rate environment. It's essentially it's a ratio. Effective duration is the price change for a 1% move in interest rates. So if interest rates on this investment move by 1%, that would be a 6.4% either pickup in price or drop in price.
Okay.
Higher rates, price goes down. Lower rates, price goes up.
So with rates rising this year, the duration has caused the drop in prices.
Right. You figure at a 6.4 duration, a 2% change in rates, that drops that investment by 12.8%. And actually, rates have moved up a little bit more than that. You mentioned that this investment or this security is down about 15. Interest rates have roughly gone up by about 2.5% when we're talking about intermediate treasury rates.
Yeah. Well, let's look at this, and we're not going to sugarcoat it. So as we mentioned before, year to date, the Lehman Ag's down 15.5. Over the last 3 months, down 8.5%. Over the last 1 month, it was worse. It's bounced in the last few days here, down 1%. But you're holding an investment in this in the bond market, and I want to position something with you. So you have, we'll call it mutual fund A, and that's let's just say it's performing and it's set up just like this. You're down 15.5%, and it's a bond investment that you expected to be conservative, that you hoped would weather the storm if stocks dropped, like we've also experienced. So what is the thought process in holding that investment now, moving forward? Call it 6 months, call it a year, call it beyond. Or it's just, hey, I'm going to punt this and I'm going to buy a 2-year treasury that are actually at 4. I'm not going to put you on the spot to make a recommendation, but what should be the thought process for an investor on, hey, I've already weathered a 15.5% drop in this mutual fund that's tracking the bond market versus I'm going to pack it in, buy a 2-year treasury, and if I feel comfortable, I'm going to hold that for 2 years, and I'm going to basically guarantee myself 4% a year. Can you just, what should we be thinking about investment A versus investment B there?
Yeah. The difference I would say is the permanence and definition of owning that 2-year treasury, right? That 2-year treasury is going to mature. It's going to pay as exactly as prescribed. And I would say that is for the individual that just cannot tolerate even the risk of a further drawdown on their investments or on some new money that they have that they're able to allocate. If you have no threshold to accumulate even or experience even more losses from here or a deeper drawdown from here, then that money probably makes sense. Or if that money absolutely has to be there at the end of 2 years, no exceptions, that money is required for something essential, that's what I would say is the scenario where the 2-year guaranteed investment, because treasuries are guaranteed by the U.S. government, makes sense. Now, from a more, let's say, opportunistic, more flexible standpoint, you've been through the crucible, right? This is the definitive worst bond market that we've seen in the modern era. I mentioned 1788. You can go back as far as you like. This is about as bad as it's gotten. 1994 held the previous record. The Fed only raised rates in 1994 by about 3%. We're on track probably this afternoon to find out that rates this year would have gone up by 4%. They might not be done yet. So I would go back to the bond math that you described. You now have a portfolio that is down 15% in total return. The price has gone down to 87 cents on the dollar. The yield per the remaining years left in this investment are yielding somewhere in the neighborhood of 4.7% per year for the life expectancy of the maturity of the portfolio. I mean, that's pretty favorable relative to other investments you can make at this point. So again, not promising that there's not more downside, but the nice thing about bonds is that there's bond math. And bonds do mature at par. Interest does get paid on a regular scheduled basis. I would say that's a pretty compelling story.
Because as those bonds gravitate from 87 to 90 to 95, that's appreciation or recovery
Right.
from the drop, plus you're getting a yield that's near 5. And would that yield possibly increase just as new bonds are getting put to work at these current rates?
Yes, that's the other benefit of an actively managed strategy or even a rebalancing index strategy.
Hmm.
Is that new bonds will be either included in that index as it gets reconstituted, or an active
Right.
manager can choose to own higher yielding, higher coupon bonds to enhance the yield in the strategy.
Yeah.
I think both have their merit.
Yeah. Well, this has been great. Thanks for talking through a number of these things. Let's close with just, are bonds still conservative investments going through this year? And do bonds still make sense in this environment? Could you maybe,
Right.
help us with your thoughts on that question?
Yeah, sure. Look, guys, we've come through a very, very difficult environment. And I don't say that lightly. And I also think we, as investors and industry professionals and investors, we have to be humble that it's a very dynamic market that's very difficult to predict. But the way I would position it is we're starting to see the market normalize. We're starting to see interest rates normalize. We've been in a
Mm.
very abnormal, unusual market where the Federal Reserve, for I think reasonable reasons, kept interest rates at zero to get us through pandemic, recession.
Right.
They increased their balance sheet to provide liquidity in a very uncertain market. But as they step away, as they get interest rates, remember it wasn't that long ago. Go back as recently as 2006, where the Fed funds interest rate was at 5.25%. Right, we're
Yeah.
talking about possibly getting back to that point. That's more of a normal environment. So I would
Hmm.
put it like this: if I have a choice that I can own a 2-year or 10-year treasury yielding in the neighborhood of between 4 and 4.5%, depending on what day we're looking, how does that look compared to what I might expect to get in terms of return from equities? And if I am a person who says, you know what, if I could get 4 or 5% from my equities next year, I'd be happy. All of a sudden, you have a real strong conversation to look at bonds, because bonds are going to do that with much more certainty at these
Hmm.
levels. Last year, you couldn't have the same conversation, right?
Right.
You're looking at a 2-year treasury yielding a quarter of a point. Like, who's going to be satisfied with a 25 basis point total return? Maybe
Yeah.
this year, in hindsight, we would have liked it, right?
Yeah.
But I think bonds, based on the painful readjustment of yields, all of a sudden look like more of a credible strategic asset class, where it was very, very difficult to make that argument, I would say even a year ago.
Yeah. Thanks, Don. Well put. I mean, it's good to know that, because I mean it's been tough. You look at this and it's almost been turned on its head. That conservative investors that are less than 50% in stocks, the rest of that allocation is typically going to be bonds, right? Some of it's going
Right.
to be cash holdings. For many of our clients, it's alternative investments like private equity and private real estate. But the fact that that bond portfolio has got a loss of -10, plus the stocks are -10, it's been a really, really tough year so far. So what we're preaching to our clients is patience. We've done some rebalancing to portfolios, trying to position and take advantage. And yeah, we're looking at a total return play on bonds. We can only look forward. We can't change the past. The past has been ugly this year, but it sounds to me that you believe that there's better days ahead, and at least we're going to get paid for owning bonds, unlike we were for the last several years. So
Yeah, I mean, look, right, Rory, buying that ag portfolio with a yield to maturity of 4.7%, when this time last year it was probably closer to 1.5%, has to be more attractive both on an absolute and relative basis.
yeah,
And look, we're just as hopeful as I'm sure you and your clients are, is that we've seen the worst of this. The market does look forward.
yeah.
And I think we've been through a very, very difficult readjustment, and I do think that better times are ahead.
Great. Well, we'll end on that. Don, again, thank you very much for taking the time walking through this. I really appreciate it. Have a great rest of the week. And once again, I'm honored that you gave us that time to kind of really go back to what's going on in the bond market, why, and then also what to look for moving forward. So enjoy the rest of the day. Thank you very much for spending time with us.
All right, Robert, it was great. My pleasure. Thanks everybody for spending time with us today.
Beautiful. Thanks.
Thank you for watching our video. Please remember to subscribe to our YouTube channel. Look at our links below for ways of getting in contact us, and message us if you'd like us to add you to our monthly newsletter.